Okay, so before we start tonight, just want to say a huge thank you to everybody for coming. It's a beautiful, sunny summer evening. We're finally getting summer. And so it's really nice to see all of these wonderful faces and see these great names joining us for WREN's monthly momentum. So we do this on the third Wednesday of each month, and it's our open session where we invite not only WREN members, but our friends, and we invite obviously our guest speakers. So tonight we have Jorian, who's going to tell us about the new CMHC Select program. Not necessarily new, but some updates. So we're excited to hear about that. And we've also invited Stephen Seltzer from Our Place Society to come along and tell us a little bit about what they're doing at Our Place and how we're going to be involved on August 4th and also for the gala that's taking place in September. And we're going to shamelessly ask for money for that because we need to start feeding more people with all of the issues that are going on in the world right now. And for those of you who maybe haven't been here before, my name's Liza Rogers. I'm the founder of WREN, the Women's Real Estate Network, and I'm joined tonight by my business partners at Crown Capital, Joan Probert. Joan is in Campbell River with a cold, working on a mobile home flip, and Lori Finnegan, who is in Victoria. And Lori and I were just working on our Belmont house together today, getting it ready for our guest who's arriving from Portland tomorrow. So never a dull moment. Stefan is here. He's my business partner on the Souk property, which are now selling. And we're also working on the Crescent property, which I'm coming to live from the Crescent property. And I'll tell you a little bit more about that if you still are interested. And I think that kind of brings us up to speed. So not going to go too much into the WREN stuff tonight. I want to give Jorian lots of time and Stephen lots of time, and we'll have lots of time for questions. And we're also going to make time for Rebecca, who I see has just joined us. Rebecca, we are going to be okay. We're going to find you money. So take a deep breath. We're going to work on getting you that money. So we'll just make sure that we get you put in touch with who you need to get in touch with the details that you need, and we're going to work on getting that cash for you to close on that property. There she is. She's like, well, we've already had a couple of conversations that are heading in the right direction, so we'll start to work on getting that finalized for you. But I think we'll be able to help, so we'll work on that, and we'll let you guys tell us about it a little bit more after we've heard from Steve and Jorian. Okay. So I would like to first introduce Steve Seltzer from Our Place Society. Steve is a very, very busy guy, and Lori and I had the pleasure of meeting him with our good friend Ian Beatty and his colleague Julian. And Steve is now here in Victoria. He's worked in communications, marketing, and fundraising in Victoria for over 20 years. He spent the last 4 years at Our Place Society managing their special events and corporate philanthropy. You know, one of the things we talk about with WREN all the time, it's not just about the money, it's about the holistic piece of our lifestyle and what we can also give back to the community. So we are going to be doing this on a more regular basis. So we're really glad to have Steve here to share more about the Our Place Society and how we can help. So just a little bit more about Steve. Prior to him being at Our Place, he was Director of Communications and Marketing for the Victoria Canadian College of the Performing Arts, increasing national awareness of the college for top training centers for arts. And of course, we're all passionate about the arts as well. He's provided consulting services to clients such as the Greater Victoria Labour Relations Board, the South Island Prosperity Project, which many of you know is one of my favorite organizations on the island, Women in Need Society, and the Victoria Chefs Association. He has a long history of holding directorship positions on local boards, including the Association of Fundraising Professionals, Canadian Public Relations Society, Victoria Press Club, and the BC Career College Association, and the University of Victoria Public Relations Program Steering Committee. So Steve, we're super excited that you're here and super excited to hear a little bit more about Our Place. And so you are up. Now, do you have any slides that you want to share? Do I need to give you power, or do you just want to let us know where we need to show you the money?
Yeah, all of the above, and the intro sounds amazing. That guy sounds incredible. Yes, I'd love if I could share screens, if that's okay.
You bet. I will make you co-host. There you go. So while Steve is just getting his co-hosting power up, again, thank you to Lori and Jeff for helping to get Steve here. And we're super excited to learn more about what's coming up with our Place Society. So we can see your screen, Steve. I think we just need to make it a little bigger, or actually it's probably me. Everybody can see it okay?
Yep.
Great. Excellent.
Yeah, I was actually working on the slides right now, so it looks like I still have to figure that out a bit. But on the right is just some stats we have for what we do in the community. You've probably seen a fair bit of information about our place lately, because we've been in the news talking about the need for supporting us right now with a high cost of food. We're facing about 30% increases in food costs right now. So we're hoping to find some new revenue streams to be able to feed the 1,000 people a day that we look to serve. We have our big gala coming up. I won't spend much time on it, but basically, if anyone has any questions, it's Hungry Hearts, and it's about amazing food. I'm going to show you the menu of the chefs we have coming this year. It's pretty incredible. It'll be at the Delta Ocean Point Resort on Saturday, September 10. We have our 8 chefs booked. We've got amazing choices of food for people to come and sample, and it's all in support of our place. We're very grateful to the culinary community who always step up to help us. It's an event we weren't able to do for a couple of years during COVID. So what we actually were able to do, thanks to Czech, is create a television broadcast. And Czech is actually allowing us to do that this year. So a week before the Hungry Hearts Gala, there will be a Hungry Hearts TV show where we'll be spotlighting our programs and our services, and also letting the world know about our amazing chefs and the food coming up. So it's a really cool opportunity. We basically, like a lot of charities, but our place has been super lucky in terms of having different groups like WREN see that basically when they support our place, the money and the support goes right to the people we serve. We're the largest emergency provider of meals in the region. We provide over 500 shelter beds, showers, clothing, outreach, medical supports, paramedics, addiction treatment services, and so much more. So basically, when support comes to our place, it's so easy for us to show where that goes. We're hoping that you guys come and enjoy a gala with us. For many people, it's the first time in years that we'll be able to get together. We'll still be asking people to make sure they're double vaxxed, and I think our numbers, we're not going to go too high this year to allow for some air in the room and so on, but we really want to not just, express our need, but show an appreciation for those who really do enhance our community. Aside from that, it's pretty straightforward what we represent in town. I don't know if anyone has any questions about the gala. Tickets are only 150 each. We haven't raised them in years. We're also looking for a couple more sponsors so that we can offset any costs, so that any money that comes to us goes right to meals. Food security, as I mentioned, that's right now, that's the cause that we're all about. For so many people, the help that we provide starts with a meal, and from then there are other pathways open. So we want to make sure that we can keep feeding our community.
That sounds great, Steve. And I think one of the things for us, for WREN, we'd love to have people join us. As I mentioned, on August 4th, we're going to be hosting a breakfast, and I think we need 4 or 5 people. Is that right, Steve, to show up and help?
Yeah, we still have some restrictions in terms of how many people, so it's up to 5 per serving.
Okay, so 5 people max for breakfast, and then we're also going to do lunch. So on August 4th, we need 2 shifts, 5 people in the morning, 5 people for lunch, and then we want to raise some money to pay for that breakfast as well. And so breakfast and lunch, Steve, is it what was it, $500 each?
500 for breakfast, 600 for lunch, and that basically covers the cost of the food. When we don't have breakfast sponsors, it's basically, you know, it's oatmeal or something. But when we can get a sponsor in, we can, you know, provide protein. We can do all we can to help people start the day with a good meal. And then, you know, we have a lot of outreach people who basically we're not pushy at all, but once we have people in there eating, we can maybe ask them how they're feeling, how they're doing, if there's some supports we can provide. And so it all starts with a meal.
Fantastic. So we will make sure that we've got $1,100 raised for August 4th, and we will be there to serve breakfast and lunch. And then, of course, we're getting a group ready to come for Hungry Hearts. I can't wait. So there we go. Anybody who wants to give some cash, let me know. And we'll probably collect the money through WREN, and then we'll make a donation, or people can probably just make a donation directly to Steve. We'll make sure that we've got the website, and you can just let them know that it's you're a WREN member and you're contributing to part of the breakfast and lunch on August 4th. So anybody have any questions about Hungry Hearts and about the gala and about Our Place Society? And Steve has just posted his email in the chat. It's stevens@ourplacesociety.com. So if you want to just grab it from the chat, feel free.
Steve, I have a question. How many people does our house, provide housing for? And with regards to the tents we still see on Pandora, is there a solution in sight for this? Like, what's being done to try to get those people that are still in the tents housing?
Sure. So second question first, that is a concern for us, and it's a concern for the community when they walk down Pandora Street and see people who with mental health challenges, with addiction issues, or just basically in front of our place. And there's a few reasons for that. One is the safe injection site next door, which is not managed by us. Basically, people go in there, they come out, and that's where they are. We try to work with the people that come to us and bring them inside. But it's also where the services are. So because other municipalities have challenges around providing resources, people converge downtown. So we do the best we can to once people come in to help in any way we can and go from there. But especially you noticed during the height of COVID, that's where people converged, is either in Beacon Hill Park, or a lot of them right in front of our site. And we do everything we can, not just for the family members, that's the people we serve, but just for the rest of the community to educate and provide options. We opened a addiction treatment center here in View Royal, where we have about 30 men who are here between 9 months and 2 years, and basically changing their lives. There isn't much for resources. There's hardly any ability for detox, and even that 30 days does nothing. So we're definitely trying to provide options and solutions as much as we can, and housing is part of that. There's only so much we can provide. We're about to open our first long-term permanent housing complex on Albina Street. It's that modular one that's being built. We're really excited because up till now we've only been able to provide temporary housing, and then slowly trying to find what resources are available in Victoria. But that's definitely one of the solutions, is more long-term permanent housing. And it has been pretty incredible, even just seeing people go from the streets to the hotels that we now manage. Just if you take a picture of them when they first come in versus how they look a couple weeks later, with meals, with security, with shelter. We know we're on the right track, but it's such a slow process. And I forgot what the first one was. I think I merged them together.
How many people do you house typically there at our house?
Now since COVID, it's over 500. I think before COVID, before the hotels, it was a couple hundred at the most. But we took over the hotel that's near Mayfair Mall, the Capital City Center, the Howard Johnson. We opened a shelter in Esquimalt on Russell Street. We are the ones that manage Tiny Town outside of Royal Athletic Park. everyone has its unique challenges, including we've heard lately that Royal Athletic Park has seen some balls fly over the fence from the Harbor Cats. So we're trying to work on a solution
boy.
for that one. But yeah, it's over 500 beds right now, and we've hired like nobody's business over the last couple of years. We've looked in Alberta, Saskatchewan. We're one of the top employers in BC, but there's still a lot of work ahead of us.
Thank you. Thanks for sharing that with us.
Good work, Steve. You guys are doing great work, and we'll Ian Beatty's been a good friend of mine since I moved to Victoria when I first arrived in 2014. So it was great for him to reach out to us and say, hey, I know you guys want to do some more philanthropic work with the group. So he connected us to you. And I think Lori and I are super grateful to have that time that we had with you for lunch and sit down and get to know you guys and see the work you're doing and just see how we can help out. So we'll see what we can pull together over the next couple months.
Awesome, thank you. I hope to see you in the future, all of you. Obviously, so many of you step up and have a lot of compassion for our community. So thank you very much.
Absolutely. Cool. Well, thank you for being here and thank you for sharing all that information. So yes, I'm looking forward to seeing in the chat box who's going to be throwing some money into the kitty. So you can feel free to just make a little note in there and I'll follow up with you. You know how I'm shameless about asking for money. So so this time, it's not going into my pocket, it's going to a good cause. So without further ado, I'm going to pass things over to Jorian. Jorian, I think you still have the power for sharing your screen.
I do.
So Jorian has been part of the group now for, gosh, I guess it's got to be almost 3 years since we've met. Hey, Jorian?
Something like that. Yeah.
Yeah. So,
yeah, thanks.
and Jorian has just been one of those people who we all love Jorian, right? Like I just, I know we just all love Jorian. So Jorian's a commercial broker. He's
even me, even I love Jorian. Yeah,
even Stefan does, right? Yeah, it's true, right? Like Stefan's like, yeah, I really love Jorian. I'm like, I know you do, Steph.
Hey, take it easy. Let's just leave it at okay. Yeah.
So we really appreciate the work that Jorian does to help us, to help WREN members, to help us look at deals together, to tell us to run for the hills. If we're looking at something, he's like, yeah, let that one go. And when we've got a hot one, he's like, oh, I think you should do something with that. And he's always been open to talking with many of the WREN members when they're stuck on something, or when they're looking for private money, or when they need to just run some things by someone who's got the expertise that Jorian has. He's been in the business for years, and we're super grateful to have him on the team. And of course, he sponsored the book. So, when we talk about the book From Ordinary to Extraordinary, and the fact that it's across Canada and we had 10 authors contribute to that, we couldn't have done that without people like Jorian. So I'm super grateful to Jorian, and I'm excited to hear about what he's going to share with us on the new CMHC program updates. And for those of you who haven't heard of the CMHC program before, he's going to give us a little bit of a backgrounder on that, and he's going to show us a property that actually we might want to be making an offer on by the end of the call. Who knows? So Jorian, it is all yours. Thank you for being here. Take it away. I know there's going to be questions coming.
For sure. And I'll try to get to all the questions, and I'll have my contact info at the end of the presentation. So if there's something we missed, or after you hang up, you got a question, feel free to reach out. I'm happy to chat with anybody. So yeah, like Liza said, I've been a commercial mortgage broker for 20 years. I do some lending. I sit on the board of a MIC. I look for money. I lend money. Real estate's been a part of my life for my whole life. My dad was a realtor for many years. And so it's something that I know and love, and I'm happy to share. And as Liza mentioned, it's a beautiful Wednesday night, and I'm glad you guys decided to tune into this rather than maybe taking a walk on the beach, or I'm sure you had other options. just before I get started, my hat's off to people like Stephen and Our Place Society that, you know, are helping people that are less fortunate. I'm going to donate to the cause. You know, Liza, you can put me down for a donation. And, you know, I try to do a little bit of that stuff myself. I could do more for sure. And, but anyways, my thanks goes to people like Stephen and people in his society. The program we're going to talk about, I'm just going to try to share my screen here. It's a fairly new take on an old program. I'm just going to try to get rid of
Just
you
go
know,
up to that slideshow button again, Jorian.
slideshow,
One right in the
yeah.
middle. Yep, right in the middle.
And then from beginning. There we go. Okay, that looks a little better.
Beauty.
So we're going to talk about a CMHC MLI Select, and it's just called multifamily loan insurance. CMHC insures loans, and their mandate is to try to help Canadians get into affordable housing. And so this particular program is a hybrid of their regular financing, where you just buy an apartment building, you get it insured, and you get a good rate from a lender. And then also a program that I think some of you attended an information session that we did at one of Liza's previous addresses on government, the RCFI program. And RCFI was a fantastic program, but the word got out, and CMHC just basically made it too hard to apply for. And so CMHC came out with the Select program in March of this year. And what it does is it allows developers to still get a bit of a break on fees, but still get high leverage and long amortization. So it's basically designed to support sustainable apartment projects where there's a need for rental supply. This is, of course, everywhere. Like, you're not going to find any municipality that doesn't want rentals. The trick to the program is finding a project that works. And so that's typically not the Lower Mainland. So, and we're going to talk a little bit about cap rates. If you have questions about that, we'll cover that off. But basically, you're looking for a project that's not priced like a West End apartment building, because that just doesn't work. You know, you're going to get 50% financing, and, you know, unless your last name's Bosa or something like that, you're not going to be able to do a deal like that. So, the example that I've got later on is in a small town. It works. You know, it still cash flows, and it's not going to suck all the cash that you've got in order to make the deal go. One of the things that we deal with CMHC all the time is what they value things as. So you go to CMHC and you say, hey, I want to buy this apartment building and I'm paying $1 million for it. And so CMHC will typically say, well, we think that building is worth 800 grand or 750. And so you'll get financing based on their value, not the value that you're buying it on. Under CMHC Select, you actually get an appraisal done, and you'll get a valuation based on market. And so we'll talk about that a little bit later, but that's an important distinction for Select, because it makes a lot of deals work that wouldn't normally work under regular CMHC financing. So what does it work for? So CMHC works for standard rental housing, SROs, single room occupancy, supportive housing, retirement homes, but we're just going to focus on standard rental housing for this presentation. So some of the details of the loan, you can do one of three things. You can buy an existing project that is in a small town that works. You can build a project that works with the numbers, or you can refinance a project that you already own. So the construction is interest only. CMHC will do it. I don't recommend using CMHC for construction unless the deal is really good, because they're difficult to work with on the draws and that kind of thing. But anyways, we'll cross that bridge a little bit further. Some of the really good things about CMHC MLI Select is that you get a 50-year amortization and a 1.1 debt service coverage. So 50-year amortization is almost interest only. So, you know, if you're going to do a standard deal with a bank and they do a 25-year amortization, it's principal and interest, and a lot of that is interest, but your principal is going to drive your payment up, way past where it would be if you had a 50-year amortization. So a 55-year amortization, for instance, is interest only. So you can imagine that your cash flow is going to really improve if you have a really long amortization, because you're not using all of your cash flow after your expenses to pay for your mortgage. The other nice thing is that if you do like a standard bank deal, they're going to want to see like a 1.2 or a 1.25 cover. And what I mean by that is, if your mortgage payment is $1,000 a month, they're going to want to see that you have a $1,200 worth of net operating income. So under CMHC, the MLI Select, they dropped that down to 1.1, which is a pretty narrow delta, and that further helps your cash flow position. CMHC loan insurance is effective for the life of the loan. So even though you would do a 5 or a 10-year deal in the beginning, you're going to get the benefit of lower rates throughout the whole amortization. So if you did a 50-year amortization and you do 5-year deals, you're going to renew that thing 9 times. And every time that you go to renew, because the loan is insured through CMHC, banks are going to give you preferential pricing. So like if you just did a regular bank deal, it's not insured, today your rate's going to be, let's say, 6.5. But because it's insured through CMHC, you're going to be about 2% less. And so even though you got to pay a fee to get the CMHC insurance, if you hold on to the building for, let's say, 4 or 5 years, that fee pays for itself. And then, anything beyond there is gravy. So CMHC is really a powerful partner if you're going to buy something and hang on to it. So the premiums are reduced under MLI Select as well. So if you're going to do, let's say you're going to buy a building and it qualifies for 85% loan to value, which is the most that you can get out of CMHC, you're going to pay a 4.5% premium of whatever the loan amount is for that. Under MLI Select, if you get 95%, you're going to pay about 2.5%. So it's quite a bit less. And on a $1 million loan amount, that's a lot of dough. So, you get preferential treatment there as well. So we were talking about 95% of cost. So if you're going to buy something and let's say it's $1 million, you really only have to put 50 grand down. So you go try to find another investment where you can get 95% of value. Like it's so good. And I don't think it's going to last. We'll talk about that a little bit later, but on a $1 million property, you got to put 50 grand down. That's a fantastic, proposition. And so you can save your cash. Like, let's say you had 200 grand to do a deal and we got you an MLI Select deal at 95%. You could take that 150 and do improvements on the building. Or you could, buy something else, do two deals instead of one deal. The 95% is dependent on a score that CMHC uses to qualify your project, and we'll get into that in a couple of minutes. So as I mentioned earlier, you can do construction, refinance, or purchases. Most people are going to do it under purchases. So if you're going to do construction, there's something that typically CMHC is looking for, and that's called a rental achievement. And so you don't get your last draw until the pro forma that you've used or the rents that you say that you're going to get are actually achieved on post construction. And so they withhold your last draw. Under CMHC MLI Select, they don't do that. And so you get all your draws if you're building. So and for many developers, that's really important because you need to get your occupancy permit if you're doing construction, and you can't get that unless you get your last draw. So you need to raise more money. But under MLI Select, you don't have to do that. So eligibility, it's got to be at least 5 legal rental units. So some of you guys probably have buildings that have illegal suites in there, like you put something in the attic or in the basement. That won't fly. CMHC will do an inspection and they'll figure that out. So if you do have a building that does have illegal units, they'll lend on the lending value that they stipulate for the units that are legal. So if you only have 1 or 2 and it's a 20-unit building, you're probably still okay, but you won't get the benefit of the underwriting on the illegal units. So minimum loan size is $1 million. And there's really two reasons for that. It is a bit of an onerous process. Like it's easier to just go to a bank and do a 75% deal or a 65% deal. There's a bit of heavy lifting, and that's part of my job, is to kind of shepherd you through the woods there and get the deal done. Also, some banks don't want to do deals under $1 million because it's a lot of work on their side as well. And if you're going to do MLI Select and you get 95% financing, you probably don't want to do $1 million deal anyway, because you can afford to do a lot more. Most people have got more than 50 grand to put into an apartment building. So one of CMHC's mandates is to respond to a need of rental supply. And in my experience, there's no municipality that doesn't want rental supply. So as long as the numbers work, CMHC is going to quote on that deal. So under MLI Select, there's a couple of different ways that you can get the points that you need to qualify for the loan. And one of them is affordability, one of them is accessibility, the other one's energy efficiency. You can do a combination of them, but affordability is sort of the most common requirement. And in my opinion, it's the easiest requirement to successfully get through, because some of the other ones, like energy efficiency, you can't really make an old building energy efficient. You'd have to rip it down and start anew. And then accessibility, making it barrier free, or making it easy for people that have some sort of handicap or some sort of mobility issue. That's an expensive proposition as well. And unless you're doing the construction, it's not something that you want to retrofit onto your building later. So the affordability part, we find in most municipalities, is not actually that hard to get to. And we'll go through that in a couple of minutes to show you how the affordability works. So you do have some net worth and guarantee requirements. So the borrower needs to have about 25% of net worth of the loan amount. So if you're borrowing $1 million, they want to see that you have 250 grand in net worth with a minimum of $100,000 guarantee. The guarantee can be in place until rents are stabilized. So if you buy a building and you've gone through the underwriting and they've agreed that the numbers all work, over time they will actually allow you to reduce your guarantee. And because there's no point in having a person guarantee 100% of the loan if CMHC has security on the building as well, because the building's not going to be worth nothing. It's always going to be worth something. So you can get that reduced down to 40% of the outstanding balance at the time that you ask for that. Some people ask for it, some people don't care. But if you end up doing multiple deals, that might become important to you later, that you have a bit of forgiveness on your loan guarantee. The other part of the eligibility is that they want you to have some experience in what it is that you're going to do. So they want you to, if you're trying to buy a 30-unit apartment building and you've had one rental in your basement, they're going to say, hey, you know what, that's not good enough. They're going to want you to either have experience of a 30-unit apartment building, or they'll want you to engage a third-party property manager. And you can do that over time. And over time, if you wanted to take over and do that, they would probably allow you to do that, like let's say within 5 years or something like that. So they would check into that, make sure that your property manager that you've hired has the experience and the competence to run your building. So affordability. So there are two parts to this that we're going to have a look at. One is for construction and one is for existing property. So under construction, if you're building a brand new building and you're just going to try to qualify under affordability, if we look at the second line there, 15% of the units are rented at 30%. So what that means is 30% of median renter income. So what does that mean? So it's different in every jurisdiction. So the deal that we're going to look at is in Quesnel, and the median renter income there means that rents have to be about $850 a month. So $850 a month represents 30% of the median renter's household income. So CMHC is saying, hey, in order for housing to be affordable, we don't want renters spending more than 30% of their income, their household income, on the rent. And so the more units that you can that you can earmark to be under that 30% of median income, the more points that you're going to get. The more points that you're going to get, the higher loan to cost that you can get. So if you get 100 points, for instance, you can get the 50-year amortization and you can get 95% of cost. If you only get 50 points, you can still get 85% leverage on the building, and you get a 45-year AM. So it's pretty good still. So, depending on the building that you choose, I can advise you as to what's the easiest way for you to get there. But if you're building a new building and you got 20 units in the building, only 25% of those units, five units in that particular case, need to be at that threshold. And one of the things that we're finding in a lot of small communities is that this median renter income is not artificially low. It's actually kind of high. Like I'm dealing with a guy right now that's doing one in Alberta, and he said, I'd love to get this median renter income because it's $1,200 a month, and I can only get $1,000 a month. So 100% of his units are going to be within that median renter income, which means that he's going to get 100 points, so he's going to get 95% financing. Guy's thrilled. So don't let that be a deterrent, this 30% of median renter income. So if you're buying an existing property, the bar is a little bit higher. And in order to get 95% financing, you would need 60% of the units to be rented at the 30% of median income. That gives you 70 points, which gives you 95% loan to value, and it gives you a 45-year amortization versus the 50-year. And so, the 45 versus the 50, it sounds great on paper, but when you do the math, it might be better just going for the 70 points and not having more units at the lower median renter income just to get an extra 5 years of amortization. So, but that's something that I could advise you on, once we've had a look at a property and we figured out, what the underwriting looks like. So the affordability portion has to be in place for 10 years or longer. And so what CMHC does is they have you covenant as the borrower. So you promise to CMHC, hey, we're going to maintain this 30% median renter income for 10 years. And then after the 10 years, all bets are off. You can go to market. Not a big deal. The affordability commitment of 20 years or more, you actually get extra points. So let's say that you only have 60% of your units that are affordable, but you would say, hey, I'll do it for 20 years. Then you would get 100%. Then you get your 95% loan to value, and you would get your 50-year amortization. So there's a couple of different ways to do it. So the new construction, I think I'll skip through that only because just in the interest of time, but we'll look at existing properties again. So to get 50 points, you would get 85% loan to value, 40-year AM, and the rental achievement might apply. So rental achievement was basically you saying, hey, I think once I take over the building, these are the rents that we're going to achieve, and CMHC would check to make sure that those are the actual rents in place. So that's pretty easy to do, especially in a smaller market. And like I just did one up in northern Alberta in a place called Athabasca, and that guy had 1 or 2 units that just got rented and are just outside of the median renter income. He decided, hey, 40-year AM for me is great, so I'm not going to lower those rents, because some people are lowering the rents in order to make these metrics work, but I don't recommend that. It's a good idea to really drill down on the underwriting and figure out, well, what's the best way to do this deal? So, and that's something that I can help out with. So the metric that I always try to go for is the 70 points, because that seems to be the easiest to get. 100 points is great, but sometimes it's a bit of an outlier. It's kind of hard to get there. So there's also energy efficiency and accessibility. And as we were talking about earlier, you can get points in that, but those points are expensive. They're hard-earned points. And that's why I recommend not doing it. If you're doing new construction, then sure, you can get there. And, new construction awards points under what's called the NECB building code. So it's basically the national building code. And so they use the building code from 2015. And as long as your efficiency is 20% better than the national building code, you get 30 points. If it's 25% better, then it's 50 points. If it's 40% better, then you get 100 points. So for instance, I did a deal last year for a guy in Langford, and it was going to cost him $1 million on 40 units to meet that part of the energy efficiency. So he just decided not to do it. So it can be very expensive. So, and then criteria for existing properties, as I was saying earlier, it's hard to retrofit a building, because, if it's windows, for instance, I've got a small apartment building in North Surrey. It's 14 units. I put new windows in last year. It was 80 grand. And I know that I still wouldn't get this 15% increase or 15% decrease over the 2015 building code. Pretty sure I'd have to do a lot more. So that's not something that I'm going to do. So that's why I usually say to my clients, let's just focus on the affordability and let's try to make that work. And then if you have to make your deal work using energy efficiency or accessibility, maybe that's not the right deal. And, deals are like buses. There'll be another one along in 15 minutes. Don't get hung up on a certain deal because there's lots of them around. So the accessibility requirements, let's skip through that. I think I've maybe sold you guys on not doing that. I'm happy to chat with you about it if you do want to do that kind of thing, but really only if you're doing new construction is this worth doing. Because like I say, it's quite expensive. I'm not suggesting that accessibility is a bad thing, but just on existing projects, it doesn't make sense to try to meet those metrics as CMHC sees them because they're just too expensive. So what reports are required? So you need an appraisal. If the project is between 5 and 24 units, then CMHC says you need an appraisal. And the nice thing about that is that CMHC on larger projects quite often will say, hey, we don't need an appraisal. We're going to do our own internal appraisal. And, for as long as I've been doing CMHC deals, I've been duking it out with CMHC on their valuations because they're very conservative. And so even though a building might trade in the market for, let's say, $5 million, CMHC takes a macro view. They say, hey, you know what? We're going to have this insurance in place for 25 years. So we don't care what you're paying for it today. We don't care that it's 5 million. It might, the economy might go in the tank. We might get massive inflation. We might get massive unemployment. So we think it's worth 3 million. So you're trying to apply for 80% financing. And so you get 80% of 3 million, not 80% of 5 million. And so on projects that are larger than 24 units, you get CMHC involved and they basically stipulate what the value is. And they stipulate what the cap rate is and what the vacancy rate is. And so we want to stay away from that if possible. So if you're going to apply for energy efficiency, then you need to get reports done. So I was telling you about this guy, our client, that had to spend $1 million on getting energy efficiency. 50 grand of that was for the report. It was just for a guy to write a report. And, I think that's really expensive and I'd rather see you spend the 50 grand somewhere else. If you're doing construction, you would need to have reports on feasibility. You would have to hire a QS, a quantity surveyor, geotechs, all the standard stuff that you would have for regular construction. And as I mentioned before, CMHC is difficult to deal with on construction, and it's not something that we do a lot of just because it's an onerous process. Other reports that you'll need are standard net worth requirements. So they would prove that you have 25% of the loan amount in net worth. They quite often do a pretty deep dive on the net worth. So you would have to provide a mortgage statement or an appraisal on your house or RSP statements, that kind of thing. They don't have to be liquid assets. You can have an RSP or you could have equity in your house, that kind of thing. It doesn't have to be cash. It just has to be assets that you own. So the other thing that we have to be careful with as well is is if all the numbers on a project work, got to make sure the building's in decent shape. Otherwise, it's going to fail the inspection. And CMHC will typically either inspect themselves or they'll send somebody else out to inspect the building. And that's a mechanical and building inspection where they're looking at the roof, they're looking at the drain tile, they're looking at the, the cladding, they're looking at the plumbing, the electrical, all that kind of stuff. So if a building is in really poor shape, but the numbers really work, we might still not get a deal. So buildings that are in poor shape are certainly an opportunity, but not under MLI Select. What I have done for some clients is they buy the project that needs a lot of work with private funds. We get it fixed up, and then we apply for MLI Select once the building is updated and it's in better shape. So we talked a little bit about fees and premiums. So you have an application fee, and this is not refundable. It's $150 per door. The other fee is basically a fee based on what the leverage is. And so if we get a minimum of 50 points, your fee is going to be 2.25% of the loan amount. And this goes down, it's a sliding scale. So if you get 70 points, so your building has performed a little bit better under MLI Select, your premium goes down to 1.75%. And then if you get the gold standard, you got 100 points, your fee is only 1%. And that's as low as I've ever seen a fee for CMHC other than RCFI, but RCFI is now off the table. And so we're not really going to talk about that, but 1% insurance fee, that's a good deal. You got to remember, if you got a 50-year AM, that insurance is in place for 50 years. That's a long time. And so CMHC is not really making money on it. So anyways, if you can get to that gold standard of 1% or 100 points, that's certainly the goal that you want to have. So how does that compare to traditional fees? Well, if you're going to do an 85% deal with CMHC under their conventional programs, you're going to pay 4.5% a fee, and that is added to the loan amount. You don't have to reach in your pocket and pay it, but that's considerable, versus getting 1%. Under construction, it's even higher. If you do an 85%, you're paying 5.25%. So, if you got the MLI Select 100 points, that 1% fee, your payback on that is obviously a lot quicker than 5.25%. So part of my job is to help you get your underwriting to the point where we can get as many points as possible. So I'm just going to move this over here because this is blocking some of my, there we go. So I've got a screen here that shows, and this is from CMHC themselves. They're saying, hey, if you wanted to use a combination of affordability, accessibility, and energy efficiency, what would that look like? And I won't leave this up there too long because we're going to focus mainly on affordability, but you can do a hybrid. You can get there through mostly affordability, but then maybe throw in some energy efficiency or some accessibility. Like I've got a guy that is doing a deal right now, and the building is fairly modern. It's, I think, built in 2010. And so a bunch of accessibility stuff was already built into the studs. So it's actually not in the building itself now. So for instance, the bathroom has wheelchair access. And so there are grab bars that aren't installed, but the shower had been built in such a way that it's fairly inexpensive to add those. And so this guy got the plans, and he's going to do part of the accessibility part because it's not going to be that expensive. So I still think that's, kind of an outlier, a bit of a red herring. So I like to focus on the affordability. So the question is, what kind of property works? And, I've been doing a lot of presentations over the years. I've been to a lot of presentations, and, you get a lot of theory, and then, what's your next step? Like, how do you apply what you've got and go do a deal? And so I want to go through a deal that that actually qualifies, that's listed on the MLS. If you want to, I'm not interested in buying it. I'm not going to compete with any WREN members, but it would work, and it would work at 95% financing and a 50-year AM. So before we get into that, what kind of property works? And I alluded to this a little bit earlier, and it's properties that are in smaller towns where the per door cost is lower, and maybe land values are a lot lower. Like anything in the Lower Mainland, really almost in the greater Vancouver area, Kelowna, Kamloops, it's almost too hard to make it work in those areas because the property is too expensive. And so how do you figure out what property works? Well, a good indication is cap rate. And so a cap rate it's a capitalization rate. And I'll spend a couple minutes on that. Just maybe not everybody knows what that is, but it's a way of deciding, well, how's a property valued? And so cap rates, for instance, in the West End are 1 to 3%. That means that's the return that you're getting on your cash that you're putting into the deal. So my question is always like, if you're getting a 1% return, why would you be in the rental business? Why not just go get a term deposit at the bank and then, have somebody else do all the work? You got no tenants, you got no maintenance, you got no rental tenancy office, all that kind of stuff. So the West End's not going to work. But in an area like Quesnel or in Powell River, or, somewhere in northern BC or northern Alberta, you're going to find cap rates that are in the 5 to, let's say, 8%. That's your target market. That's where you want to be. And so we'll look at a deal right now. This particular building is in Quesnel. And I chose this building for a couple of reasons. One, it's had some recent upgrades done to it, and it presents well, looks decent. And I think I think the cost per door is pretty low, but there's also still some upside. And but before we jump into it, I think the only negative to higher cap rate deals is that you're not going to get the kind of appreciation that you would see in downtown when markets are really good. So for instance, in the last 10 years, apartment buildings in the West End have just skyrocketed in value. That's not going to happen in a place like Quesnel. You're going to get more measured growth. You're going to get your 2 or 3% or 5%, annual growth, which is fine. Somebody else is paying off your building, and you're getting some get rich slow appreciation over time. And I think that's a good way to go because A, it's affordable, and B, you can actually do it. Like I don't do a lot of business in the West End or in the Lower Mainland, just because most of my clients are like us. They're they just can't afford to put 50% down. So consequently, I don't do a lot of those deals, and I think that they're just not that good of a deal. There's a lot of foreign money that comes in, or REIT money, or multi-generational money that comes in and puts 50% down. But for most of the people that are like us, that are part of a real estate group, they're not interested in that. They're interested in maximum leverage and where the numbers that work. So anyways, this building, it's got 16 units. It's 2 buildings. It's actually a fairly large lot. So you could actually even build another building maybe down the road, because there's plenty of room to do that. This one qualifies at 70 points. So you're going to get 95% loan to value and a 45-year AM. So that means that you're going to get a loan of $1,710,000. And so with an asking price of $1.8 million, you only got to put down 90 grand. So if you can qualify on the net worth portion and you can get some management in there, this deal could be had for 90 grand. Pretty good deal. So how did we come up with these numbers? So this particular slide is just talking about the income. And so at the top of this slide, you'll see that the median renter income is $867. So that's what CMHC has said is affordable. So this particular number comes from Prince George, because Quesnel is a small enough market that CMHC doesn't actually have all the market knowledge on it. And so what you typically do is you say, well, okay, there's no published info. So before I go out and get an appraisal, we'll see what's the closest center to Quesnel where this info is published, and this happens to be Prince George, and so it's $867. So almost all the units in this building qualify for that. And maybe with some tweaking, we could make all of the units work, and we could get to that 100 points, that gold standard that we were talking about before. So as I was mentioning earlier, the vacancy and cap rate for MLI Select deals will come from the appraisal versus CMHC. So this is what I was talking about earlier when you're talking about CMHC saying, hey, well, sure, it's selling for $1.8 million, but we think it's worth $1.5 million. So you're only going to get 95% of $1.5 million. So that's going to kill the deal for most people. Whereas with a small market deal like this, 16 units, you get an appraisal, and CMHC is going to take the numbers off the appraisal. So in this particular case, the rent roll shows that 80% of the units are affordable. And if we can confirm that, we'll get the 50-year AM and the 50-year amortization. And we might be able to get to, that 100 points. But that's something that we would have to work on once we make an offer and we kind of drill down on the income statements. A lot of these buildings, and Liza will attest to this as well, it's really hard to get competent income and expense statements, because a lot of these buildings are owned by unsophisticated people. It's a mom and pop, or it's somebody that inherited it, and they just, they got 2 or 3 buildings maybe, and they just lump all the expenses together, and they lump all the income together, and then it's hard to kind of parse through all that and figure out what's real. And so typically what I do is I try to get at least a rent roll. And so at least that you can quantify. So the rent roll just tells you who all the tenants are and what they're all paying. And so that's pretty hard to fake, and versus expenses. And then usually depending on the age of the building, where it is, what condition it's in, I can pretty much estimate within a pretty close margin what the expenses are going to be. And so for this building, for instance, I think that they're 30% because the building looks well kept. It was built in the 70s, so I know it's not super energy efficient, but it was built up in Quesnel where it does get cold, so it's probably pretty good. And so that's how I was able to make these numbers work. So that kind of dovetails into our next slide here on the expenses. So I knew a few of the expenses, but I didn't know all of them, and so that's why I jumped ahead here. So I knew, for instance, from talking to the realtor that what the insurance was. I knew what the property taxes were, and then also knew what the sewer and utilities costs were. The rest I sort of estimated, but I'm pretty sure that I'm fairly close. So this building here works on the 70% or the 70 or the 100% or the 100-point metric that we were talking about earlier. So this slide just talks about what the debt is and how the cash flow works. And so earlier we were talking about the DCR. So the program requires a 1.1 DCR. So if you've got $1,000 a month in mortgage payment, you got to have $1,100 a month in net operating income. And so net operating income is your gross rental income minus your expenses. That gives you your net operating income. So this particular building, using a rate of 4.17 for your interest rate for a 5-year deal, that's a 1.21 cover. So we know we're in good shape there. We're going to get 95% of appraised value because the rents work. The interest rate that I'm using at 4.17, that was as of yesterday. Now, CMHC rates change every day. And if we were talking about this deal in January, it would be a lot better because rates have jumped 200 basis points or a full 2%, which that doesn't sound like a lot, but in my business, that's a huge amount. And that can make or break many deals. Even 100 basis points can kill a deal. And so as of yesterday, it was 4.17. I don't know what's going to happen in the future. Anytime anybody ever asks me to predict, I can guarantee you whatever I say is wrong. Who knows? I think personally that rates are going to keep going up a little bit into the summer, and then in the fall, maybe in winter, they're going to come down again. So the 4.17, maybe we're going to top out at 4.5. And, part of my job would be to see, hey, does it still work at 4.5%? I don't know that, but I suspect that it probably would. So anyways, this particular deal, your payment on a mortgage of $1.7 million is $7,000 a month. So if anybody has a mortgage amount of $1.7 million, you'll know that $7,000 a month is a really low payment. Like normally, if you have a principal and interest loan and you're paying 4.5% and it's a 25-year amortization, you're paying $18,000 a month. So you can see how that really affects your cash flow. There's way more cash flow, way more cash in your pocket at the end of the month. So the fees on this particular deal, depending on what the loan amount is, I didn't add that to this particular loan amount, but they might be as low as 1% of that loan amount. So it might be another 17 grand. The loan cost there, I've got in at $17,000. I'm not a volunteer worker. I get paid to do what I do. I think that I'm fair, and I charge 1% of the loan amount to arrange this kind of thing. So that's pretty much a market rate. I've heard some people charge up to 2 and 3%. I don't do that. I've heard other people charge less. I think 1% is fair, and that usually gets deducted off the loan amount. But the fees that CMHC charge, those get added to the loan amount. So the key takeaways, that you might want to just keep in your mind. MLI Select works in small towns. So if you see that it's got an advertised cap rate and it's above 5%, that might be a property worth giving a call and say, hey, can I get the rent roll? Can I get the income and expense statement? And if you get those two things, then you can decide pretty quickly whether or not that's something that you want to pursue. Up to 95% loan to value or loan to cost is attainable. Loan to cost is really is a term that's used for construction. So you'll get 95% of your construction costs. So that's what LTC means. Amortizations up to 50 years under this program are possible. Insurance fees are reduced versus regular CMHC programs. If you recall, if you're going to try to do a construction deal at 85%, you're going to pay 5.25. If you get a 100-point deal and you're doing construction under MLI Select, you only pay 1%. Hell of a deal. Affordability rental rates are attainable in many markets, and if you go back up to the cap rate and you say, hey, well, this is a 6 cap, it's probably going to work. Some areas like Kitimat don't work. And the reason for that is, even though the per door price is really low, because there's a 0% vacancy rate in that market, rents are going to be really high. And like Fort Mac, before they had the big fire, for instance, in northern Alberta, Fort Mac, their rents were the same as Yaletown, and so that's not going to work. And so there are certain areas that don't work, but just look at what the cap rate is, and if you've got a 5 cap or better, it might work under CMHC MLI Select. This last point I think is an important one, and I don't think this program is going to last forever for a couple of reasons. MLI Select, if you're buying a building, let's say this one in Quesnel, and you're saying, hey, I'm going to take all of these rental units and I'm going to say for the next 10 years, I'm going to make them affordable, but you don't change the rent, then you're not really adding to the rental supply. Those units are already in the market. And so, but it gives the CMHC the opportunity to just tick a box somewhere. And when they go to the feds and the feds say, well, how'd you do on the MLI Select? We'll say, hey, well, we did this deal in Quesnel and all those units are now affordable. Well, they were affordable before because the rental rates work under this program. So there's no net gain for CMHC, but they get to tick a box somewhere so that they justify keeping the money in the program. So not all deals are affordable, as I was just telling you, but many deals are. And so I think that eventually CMHC is going to catch on and they're going to say, you know what, developers are making a lot of money on this deal and we got to change it. So this is what happened to RCFI, the Rental Construction Financing Initiative, where we did a deal 2 years ago where the money was lent out at, I think it was 1.6% for 10 years. I've never seen a deal like that before. There were no fees because you borrowed the money directly from CMHC. And so CMHC thought, well, holy crap, we're putting all this money out and developers are getting rich. So we're going to change the program. And so RCFI became a really difficult program to qualify for. I think the same thing is going to happen to MLI Select, because over time, CMHC is going to see a lot of buildings coming into the program, but no new net rentals, like no net gain on the number of units that are coming into, that are coming into existence. So they'll probably focus more on the construction, and they'll make the buying an existing unit under this program. I think they'll make that harder. And so there's no time like the present. I know rates are high right now, but they're not always going to be that way. But I do think that if it works, MLI Select is going to change. And so the other thing to keep in mind is, let's say you did do a deal and you're like, wow, geez, I got a 4.5% rate. If I'd done this a year ago, I could have got 2.5. It's only a 5-year term. In 5 years, you can go back out to the market and you can get the benefit of whatever the rate is at that time. So MLI Select, great program. If you're thinking of jumping in, don't wait. I'm happy to help. There's my contact info. The Quesnel listing came from a buddy of mine who's a commercial realtor. His number is listed right underneath there. Chris Winkers, another Dutch guy like me. He's cheap, doesn't like to spend money where he doesn't have to. So we make a good team, and he'd be happy to talk to you about deals as well. So anyways, that's my presentation on MLI Select. If there's questions, I'm happy to answer them. I'm just going to try to figure out how to see them here.
I can help you with that, Jorian.
Okay.
So there'll probably be a few. I think everybody was so engrossed in your presentation.
Thanks. You're too kind.
Oh, I think we were. It was like silence. There's a lot of times there's chatter back and forth in the chat box, but nope, everybody was like listening intently. That seems like a great little building. I think, basically $100,000 down is going to buy you an almost a $2 million asset. So
it's a great deal.
Not a bad little deal. I'm sure there will be people that will be interested in that by the end of this call. If there's not, then then there's a misunderstanding of what a good deal looks like, because that's a pretty sweet opportunity. So Danielle says old building, asbestos, mold issues. Yeah, sometimes, but those are, you can deal with those. They come up in the inspection. There's still a lot of old buildings, I'm living in a building that was built in 1949. So it depends on how well it's been maintained. So fire away your questions, folks. Now, before we stop sharing Jorian's screen, did anybody want to see any of the slides again, just before we take that down? Then Jorian can look at all of our faces while we're asking those questions.
Sure.
Got some questions.
Yeah.
Go for it, Steph.
Did you do a cash flow calculation on that? What the actual cash flow would be?
Yeah. So that particular building, I think it's about $5,000 a month.
Okay. After all expenses and everything.
Yeah, you got it.
So $5,000 on $100,000 investment.
That's pretty damn good.
Okay. Yeah. And we're talking a month, not a year.
Mm-hmm.
We're talking about a month. Yeah.
Yeah.
That's a very good return on investment, actually.
How hard would it be to actually qualify for that? Like, what are they looking for in the client? I know there's a certain couple things that they want, but what would the details be of a client?
So so net worth and experience are really the two that they're most that they're most interested in. So if you have 25% of the loan amount in net assets, and like I say, they don't have to be liquid, then that would satisfy that metric. And then they also want the borrower to have experience in managing a unit that's the same size and scope of what it is that you're building.
Or you need a hire a third
or you
party.
need a property manager. And so in my expense statement, I put a 5% management fee. So, which is typically what a management company would charge. And so I've already made arrangement for that in my income and expense statement.
Right. So in a somewhat, let's say, inexperienced investor, 25% of the purchase price in assets, and then allowing for a management company would qualify the average person for such a purchase.
That's right. Yeah. They're not
To simplify,
terribly
to make
interested.
it simple.
Yeah, to make it simple. Yeah, they're not too interested in your personal income. Like on the residential side, mortgages are adjudicated on, how much money do you make? What's your disposable income? Yeah, and on the commercial side, commercial lenders, they really just rely on the building's ability to service the debt, not the borrower. So, or the guarantor, and so they would do a credit bureau, make sure that there's no skeletons in the closet, but your own income, like lots of investors write down their income to strategize on their tax exposure. And so, CMHC understands that. But if the building cash flows, that's really the most important part. But, as far as the guarantor is concerned, you need 25% net worth, and you need some experience running the place, or you need a management company.
Right, because as I understand it, they want to know that you have enough money in case something goes wrong, in case it needs a new roof or some new windows, or that you have enough funds that you can do whatever repairs or upgrades that are needed.
Yeah. And sometimes they'll say, hey, we want you to have what's called a replacement reserve. And so that's 2% of your gross income per year that is set aside in a bank account. So when you do one of these deals, CMHC provides the insurance, but there's a bank that provides the dough. And
Right.
so that bank then would be one of the requirements of their due diligence is to make sure that you're maintaining a bank account that's got 2% of the gross going into it every year, and something that would be audited by CMHC, at their choosing.
Right, the same as a strata contingency fund, essentially.
Exactly, same sort of thing. Yeah, you
Yeah.
got it.
Okay, that's
Yeah.
great. I appreciate the simplicity of that. Thank you.
Yeah. Good question, Steph. Good to help people clarify how simple it actually is. I mean, one of the things with most of the people on the call, most people have some real estate experience or are connected to people that do. So it's kind of, you can use the people in your team to be your property managers, not as property managers, but to get that expert experience, right? So if you're partnering with someone who's been doing that, that's perfect. And then the cash flow, $5,000 a month cash flow on $100,000.
Yeah, I would have to confirm that, but if I recall correctly, I should have put that in my slide because it's a great question, Stefan.
Yeah.
Yeah,
But I
essentially you
confirm that.
would essentially have your capital back within a couple of years.
Yeah, it's your return on investment is really fast and really good.
Yeah,
And,
great return on investment. So
one other thing I was sorry, Laurie, just to cap off the management thing, I would recommend that anybody that does these deals get local management anyway, because unless you live there, you're not going to want to deal with getting a contractor on a Sunday night to fix a toilet, or to go to the RTO because some guy's not paying his rent, or things like that. If you live in the town where you're finding the investment, sure, I can understand that. But if it were me, I would be happy to pay a guy 5 points so that it's, totally passive.
yeah.
Well,
And
if you're an
Jorian-
out-of-town investor, locals probably couldn't care less of ripping you off. But if they're dealing with Bob, who lives down the street, they know he can show up at their door anytime, they're going to be a little bit different, probably.
Yeah.
Sure.
And Jorian, one of the things that we've talked about in the past as well, we've talked about if you're looking at property out of your geographic area, the cap rate has to make sense, because if you do have to get there in an emergency, you have to factor that in, right? So the fact that this one's in BC, that it actually looks like it might cash flow well, 45-year amortization, qualifies for the program. the geographic area piece isn't a detractor from it, because there's so many other good things about it. You know, we talk a lot about people who buy that one single family home outside of their geographic area, and they end up regretting it, because it's like you've got one door across the other side of the country, and it's a pain in the ass. If you're going to buy something outside of your geographic area, buy a multifamily. I mean, what was this, 17 units, Jorian?
16 units.
16 units. So I'd much rather be flying to deal with 16 units than one unit and one tenant. Good question from Jonas. What is the timeline to arrange financing? So CMHC's hired some new staff. Hey, Jorian?
Yeah, so if you recall, when we did the RCFI presentation, they had so many applications that they were 4 months before they even picked up the file. And so, you know, if you're buying a project, no vendor is going to give you a 4-month, you know, due diligence period. So that was a bit of a deal killer for lots of people. But under MLI Select, the bank is doing a lot of the due diligence, and so the lead time has changed drastically. So it's about 30 to 45 days under MLI Select now.
That's awesome. So 30 to 45 days is,
Yeah,
on a commercial property seems
pretty fast.
so reasonable. Lori,
Yeah.
you were waiting to jump in there.
That was actually my question. I was just going to ask you, what do you suggest you put in for the subject removal timeline? So say 2 months if you can get it. I mean, the market's obviously shifted, so we aren't having to jump in with no conditions right now, which is kind of nice.
You're right.
But you would suggest maybe a 60-day timeline if we can get it.
Yeah, if you can get 60 days, it just takes the pressure off. You know, and you don't have people running around with their hair on fire and making mistakes and that kind of thing. And so if you can do 60 days, great.
Thank you.
Nobody around here runs around with their hair on fire, Jorian.
Well, you haven't been to my house then.
No, I'm actually waiting for all of the fingers to start pointing, and I know Rebecca and Maggie are running around with their hair on fire right now. We're going to get to them shortly, because I know they need to borrow some money fast.
Right.
Yeah, I think this is a great opportunity. I mean, who's gonna Stefan's just walked away. We should probably wait for him to get back to ask the question, who's gonna write the offer on this building? Look, he's laughing. He knows what's coming. It's kind of a no-brainer, really.
Oh God, I've heard that before.
Yeah.
We've seen a couple no-brainers today. So yes, if anybody is interested, I mean, it's Jorian.
I think it's definitely worth exploring. And Jorian, you know, feel free to jump in here anytime. Like you said, I agree with you. I don't think this opportunity will be around for a long time. And so it's probably worth looking what deals fall into this, as they may make sense now and they may not make sense a year from now with this opportunity.
Well,
Yeah,
the
I agree.
program might be gone a year from now.
That's my point.
Yeah.
That's what I mean.
Yeah.
Yeah. So,
Yeah.
you know, is it this building? Is it another building? I guess, you know, Jorian, we could talk to you about what have you looked around at, and do you know the current marketplace for things that fall into this program right now? So
Probably about 1% of the buildings you look at, maybe, Jorian?
Yeah, there's not many, and it's very true. Like I looked at one today, and it didn't work, and it was in a smaller town. But you know, I'm sure most of you have realtors that you know and have dealt with in the past. And if you say, hey, look, I'm looking for something that's you know, $1 to $3 million, and it has, let's say, 20 units in it, and it's a 5 to 8 cap, you know, send it to me. Let me have a look at it. And I'm happy to have a look at it on your behalf.
That's awesome.
have you looked around at the current marketplace, like at most of what's out there, or is there lots of possibilities other than this building that you've seen?
There's lots of possibilities. Yeah.
Okay.
Yeah.
Okay.
Very
I
cool.
have a quick question.
Go
Is
for it, Rebecca?
it all across Canada, or is it just in BC?
All across Canada.
And Jorian, where do you supply mortgages to? Which provinces?
I work with for DLC Commercial, and we have offices from coast to coast.
Thank you.
So for those of us, because one of the reasons we decided to do this presentation tonight is, Jorian's been seeing that we've been interested in the East Coast for such a long time, right? I mean, Darlene's out there. I really feel like we missed some opportunity out there when I was jumping up and down about Moncton 2 years ago, and I couldn't get anybody on that train with me. And now it's like the #1 real estate investment opportunity in Canada. So yeah. But yeah, those multifamilies that are coming up on the East Coast, people are definitely looking at those, and we have good property managers and good boots on the ground in the East Coast, right? So, and again, for people who are maybe new and thinking, well, I may not qualify on either the